Welcome to Breaking News to Trading Moves. Today we're looking at a capital allocation story that is, well, so large it feels less like a corporate budget and more like a national infrastructure project.
It's good to be here. And you're right about the scale. We often look at, quarterly earnings or small product updates. Today, we are looking at a $50 billion check being written.
Specifically from Oracle. The headline is that Oracle has announced plans to raise somewhere between $45 and $50 billion in their fiscal year 2026.
And they're going to the markets for this, a mix of debt and equity, to get all that cash together.
To put $50 billion in perspective for you, that's roughly the GDP of a country like Jordan. I mean, it is an immense amount of liquidity.
And it's all being summoned for one specific purpose.
Right, which is the core of our discussion. This isn't for dividends or, buybacks. This is purely for capital expenditure. They're pouring it directly into Oracle Cloud Infrastructure, or OCI.
Exactly. This is about capacity. The AI competition has moved past the hype phase and into what I'd call the industrial phase. Oracle has signed contracts, real legally binding demand from some of the absolute titans of the industry.
I was just looking at that client list. It really shows the scope here. We're talking chip designers like AMD and NVIDIA themselves. Then you've got consumer giants like Meta and TikTok, and then the heavy hitters in pure research, OpenAI and xAI.
And all of those companies need somewhere to train their models and run inference. They've tapped Oracle to provide that space. So Oracle has the orders, but they don't yet have the physical computers.
They need $50 billion to build the machine that fulfills those contracts.
That's it.
And that's our mission today. We're going to follow that money. When $50 billion leaves Oracle's bank account, it has to land in someone else's. We're going to break down the specific sectors and tickers that are the winners, the ones getting that spending.
But we also have to look at the other side of the coin. If Oracle is aggressively building out and taking share, who is losing it? So we'll also look at the losers, the incumbents and related industries that face new pressure because of this move.
So let's start with the physical reality. I think there's a misconception that the cloud is soft or, ethereal. It's not. It's steel and concrete and copper.
It is loud, hot, and very industrial. So our first segment is infrastructure and hardware. This is the first place the money hits. You can't turn on a server until you have a building that can actually handle it.
And the requirements for these AI data centers are totally different from the data centers of, say, 10 years ago, right?
Oh, completely different. The density is the key. When you pack thousands of these modern GPUs into a rack, they generate an unbelievable amount of heat. Old school air conditioning, just blowing cold air around, it doesn't cut it anymore.
Which brings us to our first winner. That would be Vertiv. The ticker is VRT.
VRT, yes. Vertiv is a leader in thermal management, specifically liquid cooling. To keep these new AI chips from melting, you often need to pipe liquid coolant directly to the chip or the rack.
And Vertiv has a big piece of that market.
They have cornered a large part of this high-performance market. So as Oracle builds these really dense clusters for OpenAI or xAI, they're almost forced to buy the high-end cooling gear.
So VRT is a direct beneficiary of that physics problem.
That's the logic. You can't cheat physics. Higher compute means higher heat. Vertiv sells the solution.
Okay, so we're keeping it cool, but we also need to plug it in. The power requirements are just as staggering. That brings us to Eaton, ticker ETN.
Right, ETN. Eaton is a really compelling industrial play here. They handle the electrical chain. Think about the journey of electricity from the utility grid all the way down to the tiny plug in the back of a server.
It's not just a big extension cord.
No, far from it.
Yeah.
You need switchgear, transformers, circuit protection, power distribution units, and this equipment has to be incredibly reliable. Because if the power fluctuates for even a millisecond, you could ruin a training run that's worth millions of dollars.
So ETN is that sort of last mile of power delivery.
That's a good way to put it. And then you have the people who actually put it all together. That's Quanta services. The ticker is PWR.
PWR. That's a fitting ticker.
It is. Quanta is the labor and the expertise. They're an infrastructure solutions provider. And there is a massive shortage of the skilled labor that's capable of building these complex grid connections and facilities. Quanta has the workforce.
So if Oracle says, we need a new substation built next to this data center in 6 months, Quanta is one of the few calls they can make.
One of the very few. So for this first segment, the winners are the physical enablers. Vertiv, VRT for cooling, Eaton, ETN for power gear, and Quanta, PWR, for the actual construction and grid connectivity.
All right. The facility is built, the lights are on, the liquid cooling is flowing. Now, we need the brains. Let's talk semiconductors and compute.
This is the line item everyone expects. A substantial chunk of that $50 billion is going to buy the actual silicon that does the math.
And obviously, we have to start with the king, NVIDIA, ticker NVDA.
You can't avoid them. NVDA. They are the standard. If Oracle's going to be hosting OpenAI, they're buying NVIDIA GPUs. It's a direct volume relationship. Oracle raises cash, NVIDIA books revenue.
But there's a unique nuance here. In the intro, we listed AMD as a customer of Oracle, but you also have them here as a winner or supplier. How does that work?
It's a sort of frenemy situation, or really just symbiotic.
Yeah.
Advanced Micro Devices, ticker AMD. Yes, AMD uses Oracle's cloud to help design their chips, but Oracle also buys chips from AMD to put in their cloud.
Why wouldn't Oracle just go 100% NVIDIA?
A couple of reasons. Availability and price. NVIDIA chips are expensive and, they can be hard to get. Oracle wants to offer its customers options. If you want a cheaper instance for a different type of workload, Oracle wants to be able to say, hey, we have these MI300 chips from AMD available right now.
So AMD sits on both sides of the transaction. They pay Oracle for cloud space, and Oracle pays them for chips.
Precisely. It's a smart way for Oracle to diversify its supply chain.
Okay, and then we have a third player here, Broadcom, ticker AVGO. People often get confused about where Broadcom fits in this whole AI stack.
That's fair. They aren't building the general-purpose GPU, no. Broadcom, AVGO, is the master of offload and connectivity.
What does that mean exactly?
In these massive AI clusters, you have thousands of chips that need to act like one giant brain. Broadcom makes the specialized silicon-like PCIe switches and custom accelerators that help manage all that data traffic inside the rack.
So if NVIDIA is the brain, Broadcom is sort of the nervous system connecting the neurons?
That's a great analogy. They also do a lot of custom silicon work. As Oracle gets more sophisticated, Broadcom's IP becomes essential for moving data between all those chips efficiently.
So to recap this segment, the money flows to NVDA for the primary brain, AMD for the alternative supply, and AVGO for that internal connectivity silicon.
Correct. But we are not done with connectivity. Because now we have to move data not just between chips, but between server racks and even between different buildings.
Which brings us to segment 3, networking and connectivity. I've heard this described as maybe the biggest bottleneck in AI right now.
It is. You can have the fastest chips in the world, but if they're just sitting there waiting for data to arrive, they're useless. You're paying for them to sit idle. The network has to be incredibly fast.
So who wins here?
Arista Networks, ticker ANET. Arista has really taken the crown in the high-speed data center switching market. They use open standards, mainly Ethernet. As these AI clusters get larger, the complexity of managing the network traffic just explodes. Arista's software and switches are pretty much the gold standard for these hyperscalers.
They beat out the legacy players by being more flexible.
Flexible, programmable, and fast. They built their business specifically for cloud giants like Oracle, whereas some of the older guard was more focused on, enterprise office buildings.
Speaking of the older guard, Cisco Systems is on your list, ticker CSCO. Are they actually capturing this AI spend?
They are, yeah. Look, CSCO is the incumbent. They're everywhere. While Arista might be winning the cutting-edge AI cluster battle, a $50 billion spend lifts the whole ocean. Oracle still needs standard routing, security, campus networking.
All the other stuff.
All the other stuff. Cisco will get a slice of the pie, simply due to their massive footprint and some recent acquisitions they've made in optics.
And then we have the long-distance runner here, Ciena, ticker CIEN.
CIEN focuses on optical interconnects.
Optical interconnects. Let's define that for everyone.
Sure. Inside the data center, you use copper cables. But when you need to connect two data centers that are, say, 30 miles apart or 3,000 miles apart, you need lasers over fiber optic glass. That is Ciena's world.
And why does Oracle need that?
Because the AI models are getting too big for one building. It's that simple. Oracle is building what they call distributed clouds. They need to link multiple data centers together so they act like one giant computer. Ciena provides the optical hardware to shoot that data across town at the speed of light.
So let's recap the winners, the recipients of Oracle's $50 billion. We have the physical layer, VRT, ETN, and PWR. The silicon layer, NVDA, AMD, AVGO, and the connectivity layer, ANET, CSCO, and CIEN.
That's the supply chain. If you hold those tickers, Oracle is effectively becoming your customer on a grand scale.
But now we have to flip the script. In many ways, economics is a zero-sum game. If Oracle is winning all this business, someone else has to be losing it. Or at least having to fight a lot harder. Let's talk losers.
Segment 4, the cloud hyperscalers, the big three.
Amazon, Microsoft, and Alphabet.
Tickers AMZN, MSFT, and GOGL.
Now, these companies are massive. I mean, does Oracle spending $50 billion really hurt a company like Amazon?
It hurts their margins.
Yeah.
That's the key. For a decade, AWS from Amazon and Azure from Microsoft, they had pricing power. If you wanted cloud, you pretty much paid their rate. But Oracle's coming in with a very aggressive strategy.
How so?
They're building a network that's flatter, faster, and in many cases cheaper for these specific AI workloads. And the big thing right now, the big differentiator, is availability.
They have the chips.
They have access to the chips. If you're an AI startup and you need 10,000 GPUs today, and Amazon says wait 6 months, but Oracle says we can get you up in 3 weeks, well, you go to Oracle.
And once you go to Oracle?
It tends to be sticky. You stay. So this forces Amazon or Microsoft to respond. They have to lower their prices, or they have to spend even more capital to catch up. Both of those things compress their profit margins.
So the loss here isn't that Amazon goes bankrupt. It's that their period of easy growth and high margins is now under serious attack.
Exactly. It signals a change from, let's say, an oligopoly to a real street fight.
Let's move to segment 5. This one is a bit more subtle. Data platforms. You have Snowflake, ticker SNOW, and MongoDB, ticker MDB.
This is about something called data gravity and bundling.
Explain data gravity for us.
Data is heavy. Moving terabytes of data from one cloud to another is slow and it's expensive. The clouds charge you what they call egress fees to take your data out.
So once your data lands somewhere, it tends to get stuck there.
Right. Now remember Oracle's history. They are a database company. That is their DNA. If Oracle convinces OpenAI or TikTok to move their compute over to OCI, the data goes with it.
And once the data is sitting on Oracle servers,
Oracle says, hey, why are you paying Snowflake a premium to analyze this data? Just use our native autonomous database. It's faster because it's right next to the chips. And hey, we'll bundle the price for you.
The bundle. The oldest weapon in business.
And it works. Look, Snowflake and MongoDB are fantastic products. They're best-of-breed solutions. But they are standalone. They run on top of the clouds. If the underlying cloud provider, in this case, Oracle, starts offering a good enough integrated alternative at a lower total price, SNOW and MDB face a serious headwind.
It's the integrated suite versus the best-of-breed app. In a tough economy, the suite often wins on value.
That's the challenge. So SNOW and MDB are on the losers list because their competitive moat just gets a little bit narrower as Oracle gets stronger.
Okay, final segment of losers, real estate. Specifically, the data center REITs real estate investment trusts.
The main companies here are Equinix, ticker EQIX, and Digital Realty, ticker DLR.
These are the landlords. They build the data center shell and then they rent it out. Usually when cloud spending goes up, these guys win. Why are they on the losers list this time?
It comes down to the build versus buy decision, or maybe build versus lease.
Walk us through that math.
If you're a small company, you lease. You don't have $50 billion to build your own data center, but Oracle does. When you have that kind of capital, it often becomes cheaper in the long run to just buy the land and build a facility yourself.
So you cut out the landlord.
You capture that margin for yourself. And Oracle has been very vocal about this. They are building massive gigawatt-scale campuses that they own and operate directly.
So every dollar Oracle spends on its own construction is a dollar that isn't going into a lease payment to Equinix or Digital Realty.
Correct. It's not that EQIX is going to lose its existing tenants overnight. But the future growth, this massive wave of AI spending from Oracle, it might just bypass them. The hyperscalers are becoming their own landlords.
That's a crucial distinction. The growth story for these REITs relies on the hyperscalers needing them. If they decide to go DIY, that growth multiple shrinks.
Exactly. It puts something of a cap on their upside.
Okay, so before we wrap up, we have to look at the risk to Oracle itself. We've painted this as a power move, but $50 billion is a massive bet.
It's a bet the company moment for sure. The risk is twofold. First, there's dilution. They're selling equity, which dilutes existing shareholders. Second, leverage. They're taking on a lot of debt.
And debt requires interest payments.
Right. They are making a huge assumption that this AI demand is durable. They are building factories for a product AI compute that is still evolving. If the AI demand were to slow down, Oracle is left holding a lot of very expensive, rapidly depreciating hardware and a mountain of debt.
It reminds me of the fiber optic boom in the late 90s.
Yeah.
Companies spent billions laying cable under the ocean. The demand eventually came, but a lot of the companies that laid the cable went bankrupt first.
That is the cautionary tale. Being early and aggressive is great until it isn't. But for now, Oracle is signaling full speed ahead.
And just one final thought for you to chew on. We talk about $50 billion like it's just numbers on a spreadsheet. But try to visualize the physical scale of this.
It is staggering. We are talking about consuming gigawatts of power. We are talking about enough copper wiring to wrap around the Earth multiple times. This is arguably the largest industrial construction project in America since the interstate highway system.
And it's all happening to teach computers how to think.
It's a brave new world.
Indeed. Well, that wraps up our analysis of the Oracle spending spree. We hope this gave you a clearer map of how capital flows through the tech sector.
Always follow the money.
Exactly. And now for the mandatory disclaimer. Please remember that everything we discussed today is for informational purposes only. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Do your own research.
Thanks for listening to Breaking News to Trading Moves. We will see you next time.